say 1 crore. We depreciated it, and in year 2000 the value came down from 1 crore to say 20 lakhs. Now we revalued from 20 lakhs to 2 crores. So what happened to that 1 crore 80 lakhs? It was credited to revaluation reserve. And how did we charge depreciation on 2 crores? Say it was a case of building. On 2 crores, how did we charge depreciation? At the rate of 5%? If it was WDV, correct? On 2 crores. On 2 crores did we charge 5%? Then? And what about revaluation?
Either we charge the whole amount and subsequently reduce the risk reserve. Otherwise, we will charge depreciation only the cost.
Only on the cost and not on the revalued amount. No, we are not permitted that way. What we are permitted is that, and how we should have done is that, we have an asset now at a revalued amount of 2 crores. We purchased the initial asset in 1990. In 2000 we revalued the asset. In 2000 we revalued the asset. Post revaluation, there we have two components. One is the original cost component as depreciated, and one is the residual value. One is the revaluation concept. What AS6 says that it is always prudent to charge the entire amount of depreciation to profit and loss account. This means what is stated that I would say that on 2 crores entire amount depreciate at the rate of 5%, assuming the rate of is 5%, and charge entire amount to profit and loss account, because you should always charge a fair amount so as to recover the cost of the assets. In inflationary situations, what happens? If we book depreciation only on 20 lakhs, it will not, what you call, be able to recoup your cost of the assets, because now the cost of the asset has increased from 20 lakhs to 2 crores. Say, assume we have let out this building. When the value was of building was 20 lakhs, say in the year 2000, obviously we would have let it at an annual rent of say 1.5 lakh. Right? 1.5 lakh. So to recover, normally, ideally, what you call the rate which we fetch if a property is let out on rent ranges from 6 to 8% or 10%. So a property worth 20 lakhs, ideally we would have got a rent of 1.5 lakhs. But if the value is 2 crores, would we get a rent of 1.5 lakhs? Surely not. For a value property of 2 crores, at least we would like to have a rent of 10 to 15 or 20 lakhs, something like that. So it said that in inflationary situations, you should always try to charge the entire amount of depreciation to profit and loss account. But at the same time, we had a guidance note on treatment of revaluation reserve issued by ICI. It stated that when the asset is revalued, to the extent depreciation attributable to revalued asset is charged to profit and loss account, as you rightly said, it can be transferred from revaluation reserve. So when we revalued the asset from 20 lakhs to 2 crores, to the extent of depreciation on 1 crore 80 lakhs, whatever we have provided to profit and loss account, we could have recouped it from revaluation reserve. So in my PL account, we do not take a hit. Whatever is there still remains there. Whatever we are doing earlier still remains, and there is no hit on profit and loss account. But only one difference was that when we revalued the asset from 20 lakhs to 2 crores, depreciation on 1 crore 80 lakhs would not have been provided at 5%. Assume the life of the factory building under the old law, assuming the life of say 50 years. When we acquired the asset, it was 1990. When we revalued, it was 2000 after 10 years. So on original cost, we are providing at the rate of 5%, assuming a life of 50 years. After 10 years, when we have revalued the asset from 20 lakhs to 2 crores, depreciation on 1 crore 80 lakhs will be provided prospectively over the remaining useful life of the asset. This means for 1 crore 80 lakhs, we would have to factor out a separate rate, which may be 6%, 6.5%, something like that on WDV. Else what would happen? The original cost component and the revaluation component, both will depreciate. After some time, 40 years or 50 years, you will find the original cost as depreciated, but the revaluation balance still remains. So that is why they stated that whenever such thing happen, depreciation on revalued amount should be charged prospectively over the remaining useful life of the asset. Okay. What about foreign currency fluctuation? Similar treatment. If an asset is subject to any foreign currency fluctuation, increase in liability, then that foreign currency fluctuation is added to the cost of the asset, and again depreciation is provided prospectively over the remaining useful life of the asset. So things are fairly simple. Now let us come to what is there for us in Schedule 2. Schedule 2 talks of two important concepts. One is the depreciable amount, three important concepts. One is the depreciable amount, one is the useful life, and one is the residual value. Three important concepts. Now, they do not have any rate. They are not prescribing any rate. They have rather prescribed your table of assets with life. What is the life of the asset? They have just stated. They have stated that the life of a building, other than a factory building with an RCC structure, is 60 years. They have stated that the life of a building, other than factory building, without RCC structure, is 30 years. Life of plant and machinery is 15 years. Life of computer is 3 years. Furniture and fixture is 10 years. Motor car is 6 years, and so on. So they have prescribed the life of the asset. They have also prescribed the life of a continuous process plant. You remember what was the rate of depreciation for continuous process plant? It was 15.63%. Earlier in the old law, the rate for continuous process plant was 15.33%. You will be surprised when on 26 March the notification first came, the life was prescribed at 8 years. Only 8 years. At 15.33, I will presume a life of around 17 or 18 years. And they prescribed under the new law only a life of 8 years. So there are a lot of hue and cry from the industry. What have you done? You have substantially reduced the life of the CPP. So we are going to take a very big hit on our PL account. Particularly the sugar companies, your power companies, all have CPP, continuous process plant. Then after 5 days, government by the notification revised the life of CPP from 8 years to 25 years. Just imagine, from 8 years to not 9, 10, 11, 12, but from 8 years to 25 years. Perhaps it was not thought of or well drafted when this notification had come. So, this schedule does not prescribe rate, it prescribes the useful life. And when it prescribes the useful life, it talks of in very simple terms that charge depreciation over the useful life of the asset. Does it mean that once this law has prescribed useful life, the old law had prescribed rates? This means the old law did not have the concept of useful life? No, the concept of useful life was there. Government, for our convenience, provided you the rates of depreciation. So now we have been given the useful life. So what is that? What is the harm? One time we have to just calculate the rates of depreciation. Under the old law we had single shift, double shift, triple shift, both for SLM and WDV. Now what we need to do? You have the useful life, calculate the rates of depreciation under SLM or under WDV method. Everything is available in the book. You buy any book, you will have the rates of depreciation. So, no rocket science, fairly simple. Now, what it says that as on the date schedule 2 comes into effect, like that, the carrying amount of the asset less its residual value should be depreciated over the remaining useful life of the asset. I again repeat, as on 1st April 2014, with the schedule 2 coming into effect, the carrying amount, meaning the WDV of the asset, should be depreciated over the remaining useful life of the asset. So let us take an example. We purchased a computer on 1st April 2013, 1st April 2013 for 1 crore. What is the rate of depreciation on computers? 40%. And on SLM, it is 16.21. So let us take SLM for simplicity of calculation. So we have purchased computer for 1 crore on 1st April 2013. So what is the depreciation for financial year 13-14? At the rate of 16%? 16 lakhs. So what is the WDV as on 31st March 2014? 84 lakhs. What is the life of computer under the new law? 3 years. How much time has elapsed before 1st April 2014? 1 year. What is the remaining useful life under the new law? 2 years. What is the WDV? 84 lakhs. So what they have stated, and they have also talked the concept of residual value to be kept at 5% of the cost of the asset. So what is the residual value of this asset? 5 lakh. So what is the depreciable amount? Carrying amount less WDV less residual value. So what the WDV is 84 lakhs, deduct 5 lakhs, so the depreciable amount comes to 79 lakhs. So what they say, from the date this schedule comes into effect, the carrying amount 84 lakhs less residual value 5 lakh, that is 79 lakh, should be depreciated over the remaining useful life, that is 2 years. So this 79 lakhs will be depreciated over the next 2 years. So what will be the amount? Roughly 39 and half lakhs roughly. So if I am following straight line method of depreciation, in year 1 I will charge 39.5, in year 2 I will charge 39.5. Calculations are very simple. Now take with the same example, let us take the case of WDV. So first year it was 1 crore, depreciation was 40%. So 40 lakhs. So WDV comes to 60 lakhs. Your residual value is 5 lakhs. So depreciable amount, carrying amount less residual value is 55 lakhs. So this 55 lakhs is to be depreciated over next 2 years. So what will be the amount? We have to calculate what will be the amount using some mathematical formula. Roughly it will be say 30 lakhs in the first year and 25 lakhs in the second year. It's like that. Now this is the first portion. Second portion, it says that from the day this schedule coming into effect, in respect of assets whose useful life has expired, the carrying amount after adjusting the residual value may be charged to retained earnings. So let us take a different case. We acquired a computer on 1st April 2011 and we are charging SLM method of depreciation. So first year 11-12, what is the depreciation? 16 lakhs. Second year 12-13, 16 lakhs. Third year 13-14, 16 lakhs. So as on 1st April 2014, what is the WDV? 52 lakhs. How many years elapsed? 3. What is the life under the new law? 3. Any balance life remaining? Nil. So what does it take? From the date this schedule coming into effect, the carrying amount 52 lakhs less residual value 5 lakhs, that is 47 lakhs, may be charged to retained earnings. The word is may be charged to retained earnings. So what I do with 47 lakhs? I charge it to retained earnings. I have the option to charge it to retained earnings. So what do I do? They have used the word it may be charged to retained earnings, means I can charge this 47 lakhs either to retained earnings or to profit and loss account. So let us assume I have exercised the option of charging this 47 lakhs to profit and loss account. If the amount is material, is not material, it may figure under depreciation. So if the amount is material, we will show it as a separate line item. So if when we show it as a separate line item, where it will be? Is it a prior period item? Is it an extraordinary item? It arises due to change in accounting estimate, because depreciation is nothing but an estimate. So we show it separately as a separate line item, adjustment under transitional provisions of Schedule 2 in respect of assets whose useful life has expired. So this 47 lakhs will be shown as a separate line item, profit before tax and non-recurring item, less adjustment under transitional provision, then we have profit before tax, then provision for tax, then profit after tax. And for this transitional provision, we will give an explanatory note to the financial statement as to what does this 47 lakhs represents. We will prepare a suitable note explaining that in respect of assets whose useful life has expired, the carrying amount after adjusting the residual value has been charged to profit and loss account. We have to give a clarificatory. Assume we charge it to, instead of charging it to profit and loss account, we exercise the option to charge it to retained earnings. So we have an opening balance of profit and loss account, we charge it to retained earnings. Do we charge 47 lakhs to retained earnings? Do we charge 47 lakhs to retained earnings, or we charge 33 lakhs to retained earnings? If I have to charge to PL account, I will charge 47 lakhs. But when I will charge to retained earnings, I will charge say 34 lakhs. Is it correct? Yes. Who said deferred tax? Yes. Because you see, whenever we prepare profit and loss account, there is an element called deferred tax. And what is deferred tax? It is the difference between timing difference of depreciation. So normally while calculating deferred tax, we take into account WDV as at year end of assets as per income tax, as per Companies Act. We take the difference and charge depreciation at the substantively enacted tax rates. So if for this year, if we have to charge, we will charge at 30% plus 12% surcharge plus 3%, or 30% without surcharge plus 3% depending upon what slab of tax our client is in. Correct? So when we charge this 47 lakhs to reserves, what happens to the deferred tax element? That deferred tax element automatically while you calculate your deferred tax gets charged or credited to PL account? Yes or no? Because when we do the deferred tax calculation, the deferred tax on that 47 lakhs of depreciation which we have charged to reserves, that will be adjusted, that will be credited to profit and loss account. So what do? The tax impact on account of, to the extent of deferred tax, that will be deducted from 47 lakhs. So assuming our rate of tax is say 30%, so 47 lakhs less 30% of 47 lakhs, whatever figure comes, we will charge to retained earnings. Am I clear to all of you? Now, a few issue arises. When we charge this depreciation as an adjustment to transitional provisions in the profit and loss account, say I had a profit before this depreciation of say 40 lakhs. Say 40 lakhs. My tax liability on 40 lakhs say comes to 4 lakhs. So I had a profit of 36 lakhs. Now due to this 47 lakhs, my profit turns into a loss. So will I be able to declare dividend? Perhaps not, because dividend can be declared if out of current profits I have a loss. So I am not able to declare dividend at least out of current profits. So if my managerial remuneration, directors are getting remuneration as a percentage of profits, what happens? That is affected. So again there is an issue. What about minimum alternate tax? We have a concept of minimum alternate tax 115 JB. Can we argue that this 47 lakhs, whatever we have charged to profit and loss account, will we get deduction of this while computing book profits? Yes or no? We should get, because whatever we have done, that is in compliance with law. If you see 115 JB, whatever the line items are there, none of the line items prevents us from charging this. There is no what you call under 115 JB. If you see items of additions and items of deduction, there is no item of addition which prohibits this adjustment. So we can fairly conclude that yes, we will get benefit of this depreciation under transitional provisions. We have also a very old judgment of Supreme Court in the context, in the case of Apollo Tyres, in the context of 115J, that was also dealing with profits, which stated that if accounts are prepared by the statutory auditors as per the applicable framework in accordance with accounting standards, and none of the items sought to be added figure it out in the items of addition under the MAT provision, then AO has very limited power but to disturb the accounts or to challenge the computation of the auditor. So one can always argue very safely that yes, we should be entitled to get deduction of this adjustment, this depreciation under MAT. And that is why perhaps initially what they have said, that stated that this adjustment under transitional provision in respect of assets whose useful life has expired, it shall be charged to retained earnings. So when they had used the word shall initially, this means you had no option but to charge to retained earnings. Correct? So retained earning means BL, profit and loss surplus. So perhaps representation was made to industries by companies which were suffering MAT, that what benefit we will get. If we are able to charge to retained earnings, perhaps we may not get benefit of MAT. That is why perhaps government made an amendment and replaced the word shall with may. And when we have the application guide also, Institute of Chartered Accountants of India has issued an application guide under Schedule 2. It also says that you either charge to retained earnings or you may charge it to profit and loss account. One more question arises, while we value stock, say it is a case of plant and machinery, while we value stock in trade of finished goods, do we consider depreciation as a part of cost of production? Depreciation on machinery, do we consider as a cost of production? Yes. So whether any adjustment to the cost of production will be made on account of this item? Yes or no? Perhaps not, because it is not a normal charge of depreciation. Perhaps not. It is not a case of normal charge of depreciation. So these were the certain issues when it comes to assets which are existing as on 1st April 2014. Whatever assets I have acquired prior to 1st April 2014, for each of the assets I have to calculate a separate rate. We discussed with an example of computer. First year, 1 crore depreciated, first year 16 lakhs. We have balance 84 lakhs. 5 lakhs gone, 79 lakhs. The rate comes to 50%. 50% will depreciate. Now we take go one step backward. Instead of 1st April 2013, say we acquired on 1st April 2012. So for first 2 years depreciation is 16 plus 16, 32 lakhs. What is the WDV? 68 lakhs. What is your depreciable amount? 63 lakhs. 68 minus 5, 63 lakhs. And what is the, how much year is remaining? 1 year. 2 years already gone. Life of computer is 3 years. So 1 year. So what is the rate of depreciation? 100%. Right? So in the first case we had a rate of 50%. Next year we have 100%. So the thing is that while we calculated this rates of depreciation for assets which are acquired prior to 1st April 2014, you may have n number of rates for n number of assets. So if you have say 1000 plant and machinery acquired over a fairly long period of time, last 10-15 years, you may end up having at least not, if not 1000 and 500, 600 rates of depreciation. For each asset, say you acquired on 1st April 2010, so life elapsed till 31st March 2014 is 10, 11, 11, 12, 12, 13, 34 years. So if it is a case of plant and machinery, your useful life under new law is 15 years. So remaining life now is 11 years, 4 years have elapsed. New life is 15 years. So how many, what is the remaining life? 11 years. For asset which have acquired, say instead of 1st April 2010, 9, it comes to 10 years. So some assets you may have with a remaining life of 9 years, some with 9 years, 2 months, 7 days, 10 years, 11 months, 16 days. You may have such long list of assets with remaining. For each of the assets, you have to calculate a rate of depreciation using some mathematical formula. So you may have rates of depreciation 32.45%, 36.87%, 69.38%, 98.99%, and so on. That will be a long list of depreciation for assets which are acquired prior to 1st April 2014. So what we suggest, again it is a matter of auditor's judgment as to how you will calculate the rates. For assets which have been acquired in a month, say in the month of April 2010, 5th April 2010, 7th April 2010, 29th April 2010. Instead of month, you may consider ignore a part of a month. Assets acquired prior to 15th April, take it as full month. Assets acquired post 15th April, ignore that month. One option. So you will have assets with 10 years, 1 month, 15 years, 2 months, 16 years, 3 months, and so on. No days. Again, based on materiality, if you find that again you have large number of assets, 10 years, 1 month, 10 years, 2 months, 10 years, 3 months, 10 years, 4 months, and so on. Assets have been acquired over a fairly long period time evenly. So if I take months, then again I may have large number of rates. Correct? So instead of months, again I may choose to shorten it. Again, there is a big concept, materiality. Instead of 10 years, 1 month, what I do? Whatever assets have been acquired prior to September, I take it as full year. Whatever assets I have acquired post September, I ignore that year. So now we have assets with useful life, remaining useful life only in years. But again, it is a matter of judgment. It is not a law. It is not written. Whatever I am saying out of experience, because we have also applied these principles where the number of assets are say in thousands, 2000s, and it is very difficult to take 10 years, 16 days, 10 years, 3 months, 20 days, and so on. So we applied judgment. Materiality is very important. Materiality is very important consideration. So based on materiality, again you may choose to ignore the days, you may choose to ignore a part of the month or even a part of the year and take full year or half year as well. Because these rates of depreciation you have to carry with you for till the time the asset comes to an end or the useful life of the asset is exhausted. So if say I have assets with remaining useful life of 8 years, 9 years, 7 years, 6 years, and so on, all these rates I have to carry with me for the next 9, 8, 7, 6 years, and so on. Because today, to that example, we said the rate of depreciation for the computer came to 50%. So next year it will be 50%, again next year it will be 50%. It may be that for assets acquired prior to 1st April, the rate comes to 36%. So this 36% we have to carry on till the assets, the useful life of the asset is expired. So it is very important that way. But yes, please.
But sir, why do we require to calculate this? Like we have to depreciate the asset over the remaining useful life.
Yes, so we have to have rates. Say if we are following either WDV or SLM, we need to have rates. If we do not have rates, how will you calculate?
But sir, in case of SLM, we don't require that.
No, if you, in case of SLM, you do not, yes, in case of SLM, even if you do not take into consideration rate of depreciation, what you will do? To the example of what you call 84, 100 lakhs minus 16 lakhs, 84 lakhs, 79, 5 lakhs, your residual value, 79 lakhs, it is to be depreciated. So what you will do? You will depreciate 38, 39.5 and 39.5 lakhs. If I apply a rate, it will come to 50%. Then if I do not carry a rate with me, then what do I do in the next year? Just think. Don't think for this year only. Think of the next year. What do you do in the next year? Again, you have to calculate how much depreciation I have charged to 31st March 2015. That will become a little complicated affair. So you have to have rates. So what is the fundamental documents which we require? Before we are able to follow the schedule 2, we must have an asset register. If we do not have an asset register, we will not be able to comply with schedule 2. Because what do we want? We want what is the life of the asset, how much depreciation has been charged. So we need to have when we acquired the asset, what was the cost of the asset, how much did we depreciate this asset till 31st March, then we have to calculate residual value. So unless we have a in substance an asset register in place with all those values and tallying with what we have stated in our balance sheet as on 31st March 2014, that table which we prepare, what we call a schedule of fixed assets, that register must tally with that, else it will be a very difficult exercise for you to chart depreciation. Now, for double shift and triple shift, they have stated fairly simple. They have not prescribed rates. What they have stated, if your asset has worked for double shift, apply 50% increase. So if your normal depreciation is 100 rupees, double shift will be 150. If your asset has worked for triple shift, add 100%. If your normal depreciation is 100, add 100 again, 100%, your triple shift depreciation will be 200. No rates prescribed. Very simple, but again it will be pro rata over the number of days the assets have been used by you. It cannot be, if I use it for 20 days in a year, then pro rata for 20 days I will calculate double shift. I have used an asset for 100 days triple shift, for pro rata 100 days I will calculate triple shift. So calculations are fairly simple. What about assets which cost less than 5,000? They have not stated anything on that. So assets costing less than 5,000 will be treated at par with assets costing more than 5,000. No separate rate is prescribed. What about, but yes, our application guide to schedule 2 says that assets costing 5,000 may be depreciated at the rate of 100% again on materiality consideration. So if I have an asset say costing less than 5,000 in aggregate purchased in a year at 2 lakhs, say 2 lakhs, 15-20 assets purchased, my profit is 50,000. Can I charge? No. Because it will not give a true and fair view. But say my profit is 5 crores and assets costing less than 5,000 is 2 lakhs. Obviously I can charge. Materiality is a very important consideration. Component approach, as we had discussed, this law specifically provides for component approach. This means it says that the asset has to be broken down into components, and it says that if you have an asset which can be broken down into parts, and if the life of the part of the asset is significant to the total cost of the asset, and that significant part has a life which is different from the life of the whole asset, that significant part should be depreciated separately. To give an example, if I say that this building has a life of 60 years, but my flooring, my ceiling only have a life of 30 years. So first I will say whether this ceiling and flooring are a significant part. What is significant? They have not defined. Let us, for the sake of assumption, say that I construe this flooring, this ceiling as a significant part of the asset, and I say the life of my flooring and ceiling is 30 years. It is a significant part of the asset. The entire life of the building is 60 years. So what they say, this significant part you capitalize in your books separately, in your asset register separately, as flooring, as ceiling. Then it will be a stupa structure without flooring and ceiling. Depreciate this flooring and this ceiling over 30 years instead of 60 years. And what happens after 30 years, or what happens after this flooring and ceiling is replaced by a new flooring and ceiling? Then knock off what after the replacement, say after 28 years we decided to replace, knock off the entire amount of ceiling and flooring, whatever is there in your block of asset, and charge it to PL account and capitalize the new ceiling and flooring to your block of assets. So it seems very simple, but it is the most complex part. I would say two things in this law in this application of Schedule 2 is very complex. One, preparation of an asset register. Although all along in Caro we have been saying the company is maintaining proper records, but all along company is not maintaining proper records. So this is first the biggest challenge. And second challenge is component approach. How do I break down assets into components? I know many of the auditors, I think it is my 10th or 11th presentation on depreciation, and people are very complex, very perplexed with this subject of depreciation. So I asked a simple question that to a gentleman, what is the audit fees? Why are you tensed? The audit fees is 15,000. I said, if your client gives you 25,000 for preparation of asset register, are you happy? Yes sir, why not? So why we are facing problem? Because there is no incentive to prepare this asset register. Because client says, I don't understand what is this asset register, what is this depreciation. It is your job. आप जानो आपको depreciation 100 रुपया लगाना है या 400. I am talking of your what you call small and medium clients. They are interested more in tax profits. They are not interested in your book depreciation. So whether you have asset register, whether you have not, whether you will provide 5 lakhs or whether you will provide 6 lakhs, I don't think hardly any client, rarely a client checks that. Unless it is subject to MAT, rarely a client checks that. What is the depreciation you have charged to profit and loss? It will check all the other figures. It will check the whenever it will tally your financial statements with its books of accounts or trial balance. It will check sales, purchase, everything, debtors figure, creditor figure, bank figure, but hardly it will check depreciation. Whatever you have provided depreciation, they will pass general entry. So there is no incentive for many of us to prepare asset register. Had it been an incentive, it would have seemed very easy after we prepare one asset register, because really it is time taking. It is not difficult at all. It is very simple, but yes, it is time taking. आप जब पहले बना like we prepared the first asset register, say it comprised of around 300 or 400. The total number of assets will be around 1,000. We took roughly 1.5 months. This client had already an asset register prepared in the past. So we started from 1st April 2014. Roughly we took 40-45 days to prepare the first asset register. Why? Because a lot of what you call it, there was no software at that point of time. We have to prepare because that was a listed company, and for quarterly results we had to prepare that asset register and do the calculation. So it took almost 45 days for us to assist the client in preparation of the asset register. And in that we made a lot of experiments as to how will you set the Excel formula, because there may be large number of we were getting very absurd results whenever we are providing depreciation. Like we calculated, say, the depreciation rate at 50%, say for that 1 crore asset. 1 crore asset, 16 lakhs gone, 84 lakhs is to be depreciated over 2 years. The rate came to 50%. So we said that next year when we copy the formula, 50% will come. Again next year we will copy the formula, 50% will come. Again next year when we copy the formula, 50% will come. So that is not practical, because the life only has 2 years. After 2 years, the rate of depreciation should come 0. So we have to set some formula that if the life has expired, don't charge depreciation. Again, there may be some problem that when you are charging depreciation, say the rate is 50%, but if you charge 50%, the residual value becomes negative. Say it comes to, say, instead of as we were discussing 84 lakhs, 79 lakhs is to depreciate 39.5 and 39.5 lakhs. Say it is to depreciate over 2 years, 3 months. So in the last year I have to retain 5 lakh as residual value. So maybe if my formula is not properly setting, residual value becomes negative. So I will charge depreciation to only till my asset till 95% is depreciated. Only till the life is expired, useful life is over, and not beyond that. So a number of checks and balances had to be set up. So initially it took 1.5 months, and I tell you, once you prepare this register, it is so complicated that if you give it to the client that you apply this for the next year, he will not be able to apply it. It requires a lot of patience to prepare this register, and hats off to our article students who prepare those registers. Tell you, it took almost 40-45 days, and the boy who was preparing the asset register, he was so dedicated. 1,000 assets, imagine 800 to 1,000 assets, and for each of the assets you have to give a formula. And once we started checking it, after 2 years again this will come to 50%, so you reset. Again some calculation, validation checks, again you reset. So it becomes very, very complicated. And if I say that I hand over this register to the client, now you prepare yourself. he will not be able to prepare that. Again, so it is a big business, but at the same time it is a management service. And under section 144 you are not permitted to provide management service. So you have to do a balance as to how you provide this service to your client. But I am reasonably sure that clients using, if you are, I am using a what you call Excel register, clients will not be able to prepare those unless they are very competent and patient people to do over the job. Any company ideally will have 200, 300 assets. Even a company with 200 or 300 assets, it will take at least week, 10 days to prepare first time. And second time also it will not take less than a week to prepare the register. It requires lot of patience and reconciliation with your financial statements. एक बार apply करने से तो नहीं होगा. You have to reconcile also whatever is coming is correct or not. Requires lot of patience. So component approach, fortunately government has given an exemption for 1 year. For FY 14-15 we need not follow component approach. This component approach will be a big challenge in the current year. Particularly in this year 15-16 it will be a big challenge. For first year 14-15 component approach is not mandatory. So we skip more discussion on this. Now we come to devaluation. This is perhaps what you call the major change when it comes to revaluation. We had discussed, we had purchased an asset for 1 crore. It came down to 20 lakhs. From 20 lakhs we devalued it to 2 crores. So when we devalued it to 2 crores, what is the breakup? 20 lakhs is original cost, WDV of original cost. 1 crore 80 lakhs is revaluation. Under the old law, what we used to do? We used to charge depreciation on entire 2 crores. To the extent of 1 crore 80 lakhs, additional depreciation we used to remove from revaluation reserve. So whatever was there in our PL was only depreciation to the extent of original cost. Our PL was not hit. So there was no issue of depreciation, additional depreciation or dividend or managerial remuneration, nothing doing. But just see. Depreciable amount of an asset is the cost of the asset or amount substituted for cost less its residual value. So it says that what is the depreciable amount? Cost or amount substituted for cost. So when I substitute this 20 lakhs with 2 crores, what becomes my depreciable amount? 2 crores. 2 crores less residual value. So when it becomes 2 crores, then what do I do with depreciation? Depreciation will be charged on entire 2 crores and nothing can be recouped from revaluation reserve. So depreciation on entire 2 crores will be charged to PL account. This was a one big change which was unnoticed even when we were preparing the June quarterly results. And when we interpreted this law in this manner, we also at times want to have a check as to what others are doing. In very few companies we found that they have adopted this approach. It was unnoticed at large by even large corporates initially. Only later they came to know that this is the provision. So it has really hit the balance sheets of many companies very much because entire amount of depreciation to the extent of 2 crores depreciation on 2 crores is charged to PL account without recouping it from revaluation reserve. You are not permitted because they define depreciable amount. Section 123 says that depreciable amount is the cost or amount substituted for cost. 123 says depreciation has to be provided as per schedule 2. So there is no option but to charge it to PL account. Then what do I do with my revaluation reserve? The balance still remains. Our application guide says that depreciation to the extent of revalued portion, that is to the extent of 1 crore 80 lakhs, whatever you charge to PL account, say you are charging at the rate of 5%, it comes to 9 lakhs. Transfer from revaluation reserve to general reserve. You cannot transfer from revaluation reserve to profit and loss account. You can transfer from revaluation reserve to general reserve. So my profit is hit. My profit may turn into loss and I will not get any benefit of this loss. I will not get benefit of this loss. Rather, if due to this additional depreciation, my profit turns into a loss, my managerial remuneration is hit, my dividends are hit, right? So even for my bank purpose, I may not be able to give a rosy picture of my balance sheet to my bankers. Again, that is a problem. For my stakeholders also it's a problem because many will not understand this impact. And what about tax? Do I get any benefit in tax? No. I do not get deduction of this depreciation on for book profit computation also because 150 JB specifically bars. It says that you will be allowed depreciation only to the extent of historical cost. not beyond. You cannot revalue your assets and charge higher depreciation and claim benefit of MAT. So, net companies which have revalued their assets to that extent are loser. Loser on account of tax, they will not get any benefit. They are not losing also on tax, but they are not getting any benefit. On managerial remuneration, ability to declare dividends, and then their distributable profits reduce. So this is a very, very big change. Now again, charging of depreciation on revaluation. Today I purchased an asset. After 10 years I revalued the asset. So depreciation will be charged on the remaining useful life of the asset. For assets which have acquired after 1st April 2014, it is very simple. You have rates, you have the useful life. Based on the useful life, you can calculate the rates. You have books published which have given you the rates. Like for, say, what you call plant and machinery. I think the rate given is, the useful life is 5 years. So I think the rate given is around 5.5 or 6%. So rates are given. So you can apply WDV, you can apply SLM, whatever you rate. So they are single rates. For plant and machinery, it is a single rate of depreciation for assets acquired post 1st April 2014. But for prior 1st April 2014, you yourself have to calculate through the asset register and every n number of rates. Now what happens if I change my, can SLM rates be different from what is there in Schedule 14? Now instead of Schedule 14, let us talk of Schedule 2. Can we have SLM rates which is different from what is there in Schedule 2? Schedule 2 does not give the SLM rate. Schedule 2 gives the life. So again, if you are following SLM method, you can have a life which is higher or lower than what is prescribed in the schedule. Whether it is necessary to provide for depreciation on immovable property. I have acquired an immovable property, say this building, and I have let it out on rent. Am I required to charge depreciation? In our opinion, although there are conflicting views on this subject, in our opinion, even on assets held as investments, we are required to provide depreciation. Whether different methods can be followed for different types of assets, can we follow for plant and machinery SLM, for furniture and fixture WDV? Yes, accounting standard permits you to charge depreciation, different methods of depreciation for different types of assets. Depreciation when WDV is already 5%, they have stated that residual value should not be more than 5%. You can keep residual value below 5%. So an asset costing 1 crore, you can have a residual value of 5 lakhs or less. But you cannot have a residual value of more than 5 lakhs. If you want to have a residual value of more than 5 lakhs, it should be supported by technical advice. So assuming we are all mainly dealing with SME companies, we will not like to tinker with the useful life or the residual value, what is given there, given in the schedule. So assuming it to be so, we have to depreciate basically 95% of the cost of the assets. Cost of the assets. 100 rupees is the cost, 5 rupees is the residual value, so 95 rupees is to be depreciated. Depreciation, whether assets used or not. What is depreciation? Depreciation is the charge arising out of efflux of time, technological obsolescence, and many other factors. So even my asset is used or not used, there is an efflux of time, there is some technological obsolescence. So therefore, depreciation has to be charged irrespective whether the assets are used or not, once the assets are ready and put together, once the assets are ready for use. Depreciation in respect of multiple shift, fairly simple, 50%, 100%. Assets for which no rate of depreciation has been laid down. This is very important. Under the old law, we had Schedule 14 which prescribed the rate of depreciation for a large number of assets. Section 205 stated that in respect of assets for which there is no line item in Schedule 14, for which no rates of depreciation has been laid down, you could refer the matter to the central government. Under this law, there is no such provision. Then what are the possible options? First, try to fix your asset within one of the line items given in Schedule 2. You cannot refer to the central government because there is no provision. You can seek clarification, but you cannot refer under a provision of the law. Or get it evaluated by an expert as to what should be the useful life of the asset. And accordingly disclose it to the financial statements and charge depreciation. Can depreciation be provided on unit of production method? As I said, we have SLM method, we have WDV method, we have also unit of production method. Under the old law, even unit of production method was permitted, AS6 permitted that. But what happened? What is unit of production method? I acquired a machinery for 1 crore. I say it will produce 10 lakh pieces of a particular product. So I said that per unit of production I will charge 10 rupees as depreciation. So in year 1 it produced 10,000 pieces, I charge 1 lakh. In a year 2 it produces 5,000 pieces, I charge 50,000. In year 3 it produces 2 lakh pieces, I charge 20 lakhs. So depreciation was what? Not constant, not any particular what you call trend. It depended upon the number of units the asset has produced. Ministry said that this concept is not workable. And why it is not workable? It said that it goes against the fundamental principle of Schedule 14, fundamental principles of AS6, where it is stated that depreciation provided in the statute has to be construed as minimum. So in year in which there is lesser production or no production, perhaps no depreciation is charged. So it again goes against the fundamental principle of AS6, and this issued a circular that unit of production method is not workable. Again in this law they have again introduced this unit of production method. Now again what happens in the year there is no production, you will not charge anything. Say in the year you have very lesser production, you will charge a very lesser depreciation. So again to that extent I said certain issues go contrary to the Schedule 6. So Schedule AS6. So again to my mind this goes contrary to what is there in accounting standard AS6. Again they have permitted, I said, you can have a useful life which is lower than what is there in Schedule 2. You can have a useful life which is higher than what is there in Schedule 2. If I have a useful life which is lower than, then there is no problem, because if my life is lower, charge of depreciation is higher. If my life is instead of 15 years, it is 10 years, I will have a higher rate of depreciation. But instead of 15 years, if I am permitted to have a life of 25 years based on technical advice, then I have a lower rate of depreciation. Again it goes contrary to AS6, because AS6 says the rates provided in the statute are to be constituted as minimum rates. To that extent it conflicts with the accounting standard, but if there is a conflict between the law and a standard, then the law will prevail. So to that extent the law will prevail. So these are some of the life of the assets. This is prescribed in Schedule 2. The rates on SLM and WDV, these are the rates, these have been derived based on some formulas, and whatever books you may purchase, these will have almost the same rates of depreciation. There is one big change. Roads, we have written 10.5.3. Continuous process plant, we have written 8/25. As we discussed, they had reduced the life of CPP from 18 years to 8 years. Then when there was representation for industries, in a gap of 4-5 days, they again increased the life from 8 years to 25 years. In roads, there is one fundamental change. Earlier, what did we do with the roads? We capitalized the roads as a part of factory building, normally as a part of factory building, right? If your client has factories, there must be roads within the factories. Where do we capitalize the cost of roads? Normally in the factory building, because in the earlier law, if you see Schedule 14, factory building included roads. But if you see the new law, factory building does not include roads. If factory building does not include roads, then it is a separate item. There has to be a separate life, and they have provided the life of roads at 10.5, depending upon, they have given a number of situations. So, if your factory building includes roads, then you have to take out it separately and apply the rates based on the useful life given here. So this is one big change, and this comes as a note. When we see Schedule 14, there were certain notes like factory building includes bridges, roads, culverts, bridges, and so on. Similarly, factory building includes this, it does not include this. In the new law also, under the schedule, we have a table as to which assets are included in what. So you will find that under the new law, roads are not included in factory buildings. So if they are not included in factory buildings, we have to have a separate line item for it. We may for line item while calculating depreciation, but while grouping in the balance sheet, we may group under factory buildings as we have been doing all of it. Because road is not a separate line item in your revised Schedule 6. Now, am I permitted to charge depreciation by both methods, SLM and WDV? Yes. there was some difference of opinion initially when the schedule had come, that once this law has come and it states that depreciation should be charged prospectively over the residual life of the assets. Some believe that it says that depreciation should be charged prospectively over the remaining useful life. So some interpret it as it says that depreciation should be charged on SLM method. But AS6 still prevails, and whatever was there in the AS6 still is there. So it allowed depreciation both on WDV and SLM method. So we have the option still to charge depreciation both on WDV and SLM method. Now if we decide to change the method of depreciation now, assuming we find this method is very complicated, and WDV particularly is very complicated because lot of formulas, lot of calculation. So we decided that 1st April 2014 we will charge, instead of WDV we will charge SLM rates. Then what do? Are we permitted? Yes, we are permitted, provided we comply with the accounting standard. Then assuming we comply with the accounting standard, how do we charge? Again we calculate depreciation under old law till 31st March 2014 on SLM method. First we have to calculate that. Thereafter we can proceed with SLM method under the new law. So retrospective calculation for all assets which are in block, that has to be done. And post, once we have done, we can apply SLM on the values so arrived at. So that is a change in method of depreciation, and if there is a change in method of depreciation, whatever schedule 6, whatever AS6 says, that it results in a more appropriate preparation and presentation of financial statements based on technical advice. You feel that my assets are recouped in a better way when I am using SLM method. Normally SLM method is followed by power industries, sugar industries, captive power units. Normally they follow SLM method of depreciation. So if I find that no, that is a more prudent way to charge depreciation, I will charge, but I have to do all my retrospective calculations. So how do I calculate depreciation? Fairly simple. The capitalized cost less estimated residual value divided by estimated useful life. So if my cost is 1 crore, my residual value is 5 lakhs and life is 3 years. So 1 crore minus 5 lakhs, that is 95 lakhs divided by estimated useful life. For 3 years I will charge depreciation. Now instead of SLM, if I follow WDV, it will be 1 minus nth root of estimated residual value by capitalized cost. And what is n? N is the life in years, remaining life in years. So if I have to apply this formula, I will use capitalized cost and capitalized cost for new assets acquired after 1st April. But we need not use this formula for new assets because we have already the rates given to us in all the textbooks and all. What about assets which have been acquired prior to 1st April 2014? Then instead of capitalized cost, we will use WDV. Like in that 84 lakh example, we will use 84 lakhs minus 5 lakhs divided by 2. In WDV, we will use 1 minus 2th root of 5 lakhs divided by 84 lakhs. 1 minus 2th root of residual value is 5 lakhs and WDV is 84 lakhs, right? Yeah.
This statement method and WDV method, if I want to change that, we change from the
Yes.
starting or from
No. If I want to change my, as we were discussing now only, if I want to change my method of depreciation, it has to be retrospective from the date of addition for all assets which are existing as on 1st April 2014. आज 1 अप्रैल 2014 को हम सोच रहे हैं कि मेरे पास 500 एसेट है, पहले हम WDV कर रहे थे, हम स्ट्रेट लाइन करें, तो 500 का एसेट का हमको रिट्रोस्पेक्टिवली SLM में डेप्रिसिएशन चार्ज करना पड़ेगा आज तक का। 20 साल का अगर पुराना लाइफ एसेट्स का, तो 20 साल का पूरा आज तक करना पड़ेगा। हाँ, अगर डिफरेंस है कुछ भी ड्यू टू चेंज, अगर ज्यादा है तो कम चार्ज कीजिए या पीएल में क्रेडिट कीजिए, व्हाटएवर इज टू बी डन। पीएल रिजर्व में ऑप्शन है। इफ एनी deficiency or excess due to change in method of depreciation from WDV to SLM or vice versa, it will charge to peer account, not to reserves. No, there is no concept. Appropriation में सिर्फ वो जाता है what is meant for distribution to shareholders or general reserve and all. अभी जो profit and loss account है, accounting standard AS5, whatever goes in determination of net profit, all has to be through peer account. Appropriation में जाता है what is profit after tax. We were not permitted to charge depreciation under income tax.
Hopefully it was the big
Yeah.
charge,
Hmm.
but now correction is done.
Hmm.
So, starting from the starting, as a contingent, we have been charged.
Yes.
The difference between
Yes. So, no, it will be not like that. See, we are, first, are we doing whatever we were doing, was it legal or not legal? Was it correct or not correct? First, if I say whatever I have charged under, say, you have charged depreciation under Income Tax Act. So, say for plant and machinery, instead of 13.91, you have charged at 15%. So, first, what was my accounting policy? My accounting policy was to charge depreciation as per Companies Act or as per Income Tax Act.
it was wrongfully.
It was wrongfully charged, but in the accounting policy it was as per Companies Act. So what we did, it was an error. So all errors had to be rectified. So errors will be rectified by way of prior period adjustments. कि हमने कैलकुलेशन गलती कर दी थी, हमने कैलकुलेशन को सुधारा, उसको प्रायर पीरियड एडजस्टमेंट में डाल दिया. अगर हमारा पॉलिसी था ऑन कंपनीज एक्ट बट हम गलती से इनकम टैक्स में चार्ज कर रहे थे, इट विल प्रायर पीरियड एडजस्टमेंट. तो हमको शुरू से लेकर अभी तक को कैलकुलेट कर लेना पड़ेगा कि हमने क्या चार्ज किया, क्या होना था, जो डिफरेंस आएगा उसको प्रायर पीरियड एडजस्टमेंट में ट्रांसफर. देन आप बोल रहे हैं कि नहीं, तब नहीं. तो आप पहला बोला कि वी आर चार्जिंग एज पर इनकम टैक्स रूल्स. तो अगेन ए क्वेश्चन राइजेस, did we seek technological evaluation? Did we mention the rates? So whatever we were charging was not in accordance with law, that was contrary to the law. Now that is sought to be rectified. That has to be a prior period. No, but then again, see, first, you are permitted to charge at a higher rate only when you disclose. We have to disclose it. But based on technological evaluation. He is not doing any technological evaluation. He is simply saying that depreciation is charged on WTV. Had I made a technological evaluation and based on those technological evaluations, say the rates come similar to income tax, then we are permitted. We cannot have a policy writing depreciation is charged on WTV. That as per income tax. So this calculation is simple. We have given some calculation. So depreciation more or less we have discussed. If there are any issues, else we go to a different topic, whatever you want to discuss. Again an overall perspective. So इस साल हम जब depreciation charge करेंगे, तो we have an asset schedule, whatever was there as per last year, original cost, addition, deduction, total. With depreciation up to 31st March 2014, depreciation for the year, there will be a column for transitional provision, adjustment under transitional provisions for assets whose useful life has expired. Then there will be a total column, then there will be a WTV. तो एक column adjustment में ज़्यादा रहेगा. Should preferred, it is preferred. Then we would have a note. If we charge depreciation under transitional provisions to PL account or to retained earnings, we have to give a note as to what is this. Again, we have to also charge depreciation as per Schedule 14, first year, for the purpose of giving a comparative information. Why? Accounting standard AS5 says that if there is any change in accounting estimate which is an effect on the profit for the current period or is likely to have an impact on profit for future periods, the impact must be disclosed in financial statements. So what is depreciation? What is useful life? It is an estimate as to how long we will be able to recover the cost of the assets. So first year we have to charge depreciation both on old law as we have been doing and new law, and we have to give an impact. Had we charged depreciation as per old law, what would have been the impact on profits? So this is another exercise, and this must be disclosed by way of an appropriate note to the financial statement. So that is again very important.
But if there is material.
Yes, but again you have to calculate, then only we will know it to be material. But as auditors, 143 says that auditors must comply with auditing standards. Materiality, we must have document to show that it is not material. Say if we are a very small company, then we are able to calculate, say a few assets, 5, 6, 7, 10, 20 assets are there. Maybe you are able to calculate it and we are able to come to a conclusion the impact of this depreciation will not be material. We can write, even in large companies, where the additional charge may not be material. But as auditors, we must have sufficient backup papers in our file. That tomorrow, if some regulator asks us as how we have written, it does not have any material impact, then we must have some backup papers in that. But tell you, first year, there normally what we have find there is a much higher charge of depreciation in the financial statements on account of this depreciation. In almost majority of our clients, we had a much higher charge of depreciation on account of this schedule, because life of assets under the new law, it has been substantially reduced almost across all assets. Computers, it was earlier 16%, on SLM now it is 33%, almost doubled. Life was 6 years earlier, now it has come down to 3 years. For plant and machinery, earlier it was around 21 years, it has now come down to 15 years. So almost all, across all the assets, almost the life has come down substantially. So there will be first year there will be a big hit on depreciation. So we have calculated. So this is all over. Now would you like to stop, or any issues on audit report, or any issues on debt deposit? Or if you have any questions on deposits, if you have any questions on audit report. Audit report, just 2-3 minutes. Under this law, we have to prepare audit report, and as per SA 700, 705, 706. So a new format of audit report has been hosted at the website of the institute. So we need to follow that audit report. Some important things. So we have an opening paragraph, management responsibilities, then auditor's responsibilities, then opinion. If we give a qualified opinion or a modified opinion, we have a basis of modified opinion paragraph. If we give an emphasis of matter, other matter, there is a separate paragraph. Then we have a report on regulatory and other reporting requirements. Some changes have taken place. We have section 143.3, which requires us to report on a few more line items. Whether the company has disclosed the impact of pending litigation on its financial position in the financial statement. We have to report on this. If the company has any pending litigation, we have to state whether the company has stated this in its financial statement. So ideally we will write the company has disclosed the impact of its pending litigation on its financial position in the financial statements, and we will draw to refer note number itna to financial statements. If there is no such litigation, we will write the company does not have any pending litigation. Then whether there is delay in transferring of amount required to be transferred to investor education and protection fund, all those 7 years dividend remaining unclaimed, those things. So if it is there, we will report. If it is not there, we will not report. And there is another provision whether the company has 3 issues were there. Pending litigation.
The income tax has been
No, that is pending litigation. On financial position is the financial statement. Whether the company has made provision for all foreseeable losses, including, if any, on long-term contracts, including derivative contracts. So these are the 3 issues which we are required to report. And it is mandatory, we have to report. Whether it is yes or no, we have to give a statement. The most important is first one. Second one and third one. Third one is not an issue at all. If there is a delay, we have to report. B, losses on long-term derivative contracts. We have all along been doing. Now we are required to report. First one is very important when it comes to disclosure of contingent liabilities. As per AS 29, we disclose contingent liabilities in the balance sheet. We have disclosed income tax disputed on appeal, sales tax disputed on appeal, excise disputed on appeal. What they say, you have to disclose the effect of pending litigation on financial position in financial statement. Assuming my company has a net worth of 1 crore. Say net worth of 1 crore. I have liabilities of 40 crores. Then first I disclose these liabilities as contingent liabilities. Management says that you see these are our demands. I have disputed in appeal. Disclose as contingent liabilities. Our duty does not end here. We cannot just disclose it as contingent liabilities and go away. We have to ascertain whether these liabilities are actually contingent or they are likely to crystallize into actual liabilities. Because say, for a company with a net worth of 1, 2, 3 crore, there is a liability of 20 crore, something happening, company is gone. Net worth is eroded. We must apply our mind to ascertain whether the liabilities disclosed as contingent liabilities are contingent and they are not actual liabilities, or the likelihood of the liability crystallizing into actual liability. What is the probability of the liability crystallizing into actual liability? We have to ascertain that. That is very, very important. There are large number of income tax demands. Just he goes to appeal so that I need not pay the amount. I'll file a stay petition, but on the face of it you can judge that no, this demand is likely, he has to pay this demand. He is very higher chance of he losing the case in the appeal and he has to pay the amount. This liability will crystallize into actual liability. So what do? We have to provide for that. We cannot just disclose it as contingent. And if need be, seek legal opinion from reputed consultants. Not normally just we have sought a legal opinion for a file and kept it. If there is any material liability, you must seek a legal opinion as what is the likelihood of this liability not crystallizing into an actual liability. Are there any past cases? Has the department done an error of fact, error of judgment in raising these demands? All we have to ascertain this. It is our responsibility to assess all this. Just filing appeal and we say that no, management has filed appeal, nothing doing. No. AS 29 gives all the circumstances as to how the auditor has to ascertain that whether a provision is required to be made for these liabilities. So we must analyze, and then after analyzing everything, and if we come to the conclusion that no, these are contingent liabilities, disclosures are not to be, provisions are not required to be made in the financial statement, we must give adequate disclosures of what are the liabilities, what is the nature of the liability, why we have not provided a liability. Like we have been giving a disclosure that this is the fact of the case based on legal advice, facts of the case, past judicial pronouncement. Management is of the opinion that these liabilities are not likely to crystallize into actual liabilities and will not have any material adverse effect on the financial position or the financial statements of the company. These sort of disclosures we have to make this. So this is very, very important. And one last thing is very important is just see clause 143(3). We have been stating all this, whether we have obtained all informations, whether proper books of account have been kept, branch, auditors, financial statements comply with accounting standard, all those things are there. F, G, H, I is not effective now. Whether the company has adequate internal financial controls and operating effectiveness, for 1 year it has been deferred. For all companies, auditors need not report. In the case of listed companies, management in the director's report will comment on internal controls. This is mandatory next year. And it is perhaps one of the most challenging in the entire audit report. ICAI had come out with a 270-page guidance note only on this clause.
That has been withdrawn.
That has been withdrawn. Fortunately, it has been withdrawn and even the provision has been deferred for 1 year. So this is perhaps the most complicated clause. For F, G and H. For F and H also, ICAI has issued a guidance note. We must go through this guidance. F and H. In what circumstances which we are to report on F and H? Observations or comments of the auditors on financial transactions or matters which have an adverse effect on functioning of the company. If there are any such matters, then we have to report in F, we have to report in H also. Any qualification adverse mark relating to the maintenance of accounts and matters connected therewith. Inventories have been valued at cost. AS2 says that inventories has to be valued at lower of cost and net realizable value. Due to this, the profit is impacted by say 20 lakhs. My profit shown in books is 60 lakhs, it should have been 40 lakhs instead of 60 lakhs due to 20 lakhs overstatement of inventories. We will qualify the report in the basis for qualified opinion or basis for modified opinion paragraph and in our opinion paragraph. Plus in F and H, both places we have to also refer to that qualification. Because this valuation of inventory at a value less than, at a value higher by 20 lakhs is an adverse effect on financial transactions. It is a matter relating to maintenance of account because accounts are not maintained as per accounting standard. So both in F and H we will give a qualification. So if there anything has to be stated as far as F and H is concerned, we have to report it. If nothing is to be stated, then these 2 points need not be reported. So we must keep in mind. At times we give qualification, but we may forget to write on F and H first. So why I invited your attention is that if you by chance give any qualification or you have anything to say on F and H, you must report. So this is very important because it is required to be reported only when we have to give a comment. 164 again is very, very important. It corresponds to old 274 1. Old law was if you are a defaulter in filing financial statements and annual return for 3 years, it was only case of public company. If a public company fails to file annual return and balance sheet for 3 years, then the directors are at default. And he is disqualified from being appointed as a director in that company and any other public company. But now 164(2) applies to all companies, both private and public. And the condition "and" has been replaced with "all." If you are a director of a company which has failed to file financial statement for 3 years or failed to file annual returns for 3 years, you are not eligible for reappointment in this company, and you are not eligible for appointment in any other company, including a private company. So unlike 274(1)(g, which applied only to public company, 164(2) applies to all companies, whether it be public or whether it be private. So this is one big change. Rest. Just on last one, Caro, very interesting. We may miss a large number of items. It does not apply to bank, it does not apply to insurance, it does not apply to section A. Very well, no problem. It does not apply to 1% company. No problem. Hardly we have any 1%. Are there any auditors of 1% company? No. It does not apply to small company. It does not apply to small company. Correct? What is a small company? A company with a capital of less than 50 lakhs as of now, plus turnover less than 2 crores. So are the conditions cumulative? It is or and?
And.
It is?
And.
Earlier it was or.
Earlier it was or.
So small companies perhaps what you call one of the most debated definitions. So if I have a company with a capital of 5 lakhs and turnover of 3 crores, am I a small company? No. Capital is 5 lakhs, turnover is 3 crores. Am I a small company? No. Because both conditions. Earlier they had written the word or. So a company, so we have to meet both the conditions to qualify as a. Now take an example. My company's capital is 1 lakh. My company's turnover is 1 rupee. Am I a small company? Company's capital is 1 lakh. It is a public company. Capital is 1 lakh. Turnover is 1 rupee. Am I a small company? Yes or no?
No, because it is a purely because of the value of the
Yes. So there are very finer things which you have to do. If a public company, a public company is not a small company. Again, I am a private company. I have a capital of 1 lakh and a turnover of 1 rupee. Am I a small company? Yes. I say no.
It is a private.
In case of a private limited company, a company with a capital of 1 lakh, turnover of 1 rupee, it is not a small company. Any holding company, any subsidiary is not a small company.
It is a subsidiary company.
It is not a small company. So again, this is important. You must keep in mind that this is not a small company, because if my turnover is if my capital is 1 lakh, my turnover is 1 rupee, I will say it is a small company. I will not report on Karo. Then we are in trouble. Again, small company also excludes one special category of company, which are companies which are governed under special acts. So if your company happens to be an NBFC, which is governed under RBI Act, you are not a small company. So even if your capital is less than 50 lakhs, your turnover is less than 2 crores, if you are a non-banking finance company registered with the Reserve Bank of India, you are not a small company. That is again, these are some important things in the context of small company. Again, as Mr. Bhatia said, even if you are a private company with a capital of 1 lakh, turnover of 1 rupee, you are not a public company, you are not a holding company, you are not a subsidiary company, you are not a company governed under a special act, you still are not a small company. Because now you are a subsidiary of a public company. So if you are a subsidiary of a public company, you are a public company. So when it comes to small company, a lot of things have to be kept in mind. And Karo, it was effective 10th April by the notification dated 10th April. And instead of now 21 clauses, we have all 12 clauses. So almost what was there in the old Karo, it is almost a repetition with deduction of certain items. So life is pretty simple. Only to the extent in one clause, when it comes to section 73, relating to acceptance of deposits. Earlier also we have to require to prove whether the company has accepted any deposits from the public under 58A. Now they ask whether the company has accepted any deposits under section 73 to 76. You all know, in case of private company, loan from directors' relatives, loan from shareholders are also public deposits. So, if the company has by chance accepted any deposits from relatives of directors or shareholders, that is to be reported. Again, if the company has already loaned from shareholders as on 1st April 2014 and they have not paid them before 31st March 15, or they have failed to file the returns, or there was a circular dated 31st March 2015, it stated that 30th March 2015, that if you have accepted loan from shareholders prior to 1st April 2014, you can continue with the loans for the remaining tenure of the loan. So assuming I had taken a loan in 2014, January 2014 for 3 years, I can continue with this loan for the remaining period also. I need not repay, it will not qualify as public deposits. It will not qualify as deposits. So to that extent we have to keep in mind. Huh? It is repayable on demand. If it is repayable on demand, this is most cases, whatever you have accepted prior to 1st April 2014, it may be repayable on demand. Now what should be constituted as a limited period? Either when he recalls, who has the option to pay? It is repayable on demand, it is repayable on demand both at the option of the company as well as the option of the lender. So two interpretations are possible. If it is repayable only at the option of the lender, we can still argue that if he has not demanded, my repayment terms are that I will repay only when he demands. Perhaps, yes, we will repay. Once he has demanded, it becomes a deposit if you do not pay. Second situation, it is repayable at the instance of the company as well, or at the option of the lender. If it is repayable at our option, and the law says that you are not permitted to take these deposits, initially they had stated that whatever is there, you pay before 31st March. Going by the spirit of law, within reasonable time we have to pay. We cannot give any, if I say repayable on demand is that whenever he demands, we will pay, or if I have intention to pay, I will pay. So, law basically wants to curb all this practice. So I said, we have to read the minds of the legislation. If you have viewer in the morning, when it comes to multiple NBFCs, we had argued and discussed this issue with RBI, and RBI at number of forums had told us that the concept of multiple NBFCs are not there. And not once, twice, thrice they were told, and we had met them at their offices also. And today, finally, when the gentleman from Bombay had come, he said that no, we had duly clarified, because initially after the 10th November notification, 10th November circular, we thought it is a framework, and they also stated that it is a framework. The last line stated that final notification is to follow. Correct? 27th March they came out with a number of notifications. Again in April they came out with a number of notifications. What our view was that there was a framework, notifications to follow, so whatever is there in the notification is the final law. In the final notification, multiple NBFCs were not there. They have also clarified us twice or thrice at open public forums, at our association, institute platform, that multiple NBFCs are not there. But today, yesterday, on 1st July, the master circular. In the master circular, miscellaneous instructions to NBFC, para 29, it talked of again the concept of multiple NBFCs. So we again said them, what is this? Again this multiple NBFC is coming. Earlier you have said that it is not there. So today it's clarified, no, it is still there. So as far as these are also concerned, we should not do some ambitious planning. Try to read this, go by the spirit of the law. If the law does not permit you to continue with these types of what you call deposits, try to pay them as early as possible. So I cannot give you a straight-jacketed legal answer. Like many legal questions were put to you. You must have seen many legal questions. What is said? Go by spirit of the law. Securities. SEBI, the large number of decisions of courts are there that shares of private companies are marketable, not marketable securities. So we have given this. And the definition of securities which he has stated in the RBI law is the same one which is there in SEBI. And interpreting the definition of SEBI in Sahara's case, Supreme Court has stated that shares of private companies are not marketable securities. And if they are not marketable securities, they are not within the definition of securities. And what is business? Business means carrying on trading something which is marketable. If something is not marketable, how can you carry on this business? So what he said, go by the spirit of the law. Don't try to, what you call, interpret the law. So similarly in Companies Act, in many places you find that you cannot do ambitious interpretation. You have to go by spirit of the law and read the lines of the law as well as read the mind of the legislation. This I my presentation. Thank you all.